Where are rates headed this year? And where can you still get a safe 9.6% tax equivalent yield right now? Hello, Diamond NestEgg members, super savers, and course fans. Happy New Year to everyone, and I hope you started 2026 healthy and well. It's still freezing in New York with some snow on the ground, which gives it a more festive look, but the markets never really stop. So, welcome to our first weekend update in the new year. Here are the three topics I'll be covering in today's video, starting with our outlook. 1. Where are rates headed this year? And where can you still get a safe 9.6% tax equivalent yield right now? 2. How do current rates compare for treasuries and annuities? And 3. What are the predicted yields for the upcoming week's treasury auctions? Let's dive in now, folks. Where are rates headed this year? And where can you still get a safe 9.6% tax equivalent yield right now? 2025 was anything but a boring year in the markets. On the equity side, the S&P 500 started the year at 5,891, fell almost 16% to 4,965 by the morning of April 9th, but then recovered all these losses and then some to reach multiple new all-time highs, ending the year at 6,846, 16% higher than at the beginning of the year, and a 38% recovery from the April trough. The roller coaster ended well for investors this time around, but it also serves as a reminder of just how volatile even broad equity indices like the S&P 500 can be in the short run. Which brings us to the bond side. Treasuries proved their usefulness again in 2025 as a stabilizing factor in many portfolios. Of course, there was movement there as well, but as expected, those ups and downs were much less severe than for equities. If we look at the 30-year Treasury yield, which probably gives us the most explicit picture on where the market thinks that the economy and rates may go in the long run, it started the year at 4.79%, then went really down and back up again twice, touching lows of 4.41% and highs of 5.08% on the way, before finishing the year almost unchanged at 4.86%. We'll look at Treasury and other rates in the later sections of this video. Let's first walk through the Fed funds rate and where we think it may go in 2026. At the moment, the Fed funds rate stands at between 3.5 and 3.75%, and forecasts for where this year will take us vary widely. No one knows where we will end up, not even the folks at the Fed, but that doesn't stop them from publishing their own projections. According to this table of economic projections from Federal Reserve Board members and Federal Reserve Bank presidents from December 2025, their own estimates for the Fed funds rate range from as low as 2.1% to as high as 3.9%. So it seems that most members of the FOMC, the Federal Open Market Committee, the body that actually sets the rates, are expecting lower rates, but at least a few have not fully excluded the possibility of a slight increase later this year. And if we look at what market participants expect in the short run, the CME Fed Watch tool tells us that almost 83% of market participants expect the Fed to keep rates steady at its current range of between 3.5 and 3.75% at the next FOMC meeting on January 27th and 28th. But a lot can happen even in 4 weeks, so we'll keep an eye on this. Also, remember that this outlook from the Fed is for short-term rates. As our Diamond NestEgg regulars know, short-term rates are what the Fed controls, meaning rates like those on T-bills. Long-term rates, such as for the 30-year Treasury at the very long end, follow their own rules and will depend more on the overall outlook for the economy in the U.S., such as GDP growth, inflation, unemployment, and so on. That said, long-term rates are still at attractive levels compared to the past 20 years, as we saw before for the 30-year Treasury, and as you can see here, for the 10-year, if you want to go out less far. And while I still have no crystal ball, and yes, I was disappointed again when I opened my gifts on Christmas morning, in any case. I do think that where we are currently continues to be a good point if you want to lock in rates while they're attractive and or want to start laying a foundation for future income streams. For example, if you're about to or are already in retirement. We are working on a deeper dive into income strategies for 2026 and what yields are realistic depending on your risk and liquidity profile. But just as a sneak peek ahead, 30-year municipal bonds, munis, with an A rating are still showing yields of up to 5%, which in the case of tax-privileged municipal bonds means that the tax equivalent yield will be even higher for everyone who pays income taxes. For example, New York residents in the highest tax brackets would need to find a corporate bond with a 9.6% yield to get to the same result after paying all their income taxes. So stay tuned for that, as we're hoping to get the first part out to you in the next few days. And if income generation and income protection are top priorities for you, we invite you to get early access to a brand new VIP member community, which will be officially launching on January 15th. In addition to your top-of-mind Treasury and agency bond questions, we'll also be diving deeper into higher-yielding income strategies such as corporate bonds, high-yielding bond funds, covered call strategies, preferred shares, and principal-protected products during the coming year. Just visit our website at www.NestEgg.com and click on this yellow private VIP member community button to grab your $100 early bird discount and check out part 1 of our members-only mini-series on corporate bond investing. For today, though, let's move on now to the next part of our discussion. How do current rates compare for treasuries and annuities? As we normally do at the end of the week, let's compare the annuity and treasury rates at the time of this taping. For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. AA+ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes in the insurance industry, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to treasuries in terms of risk-return profile. And remember that MYGAs work essentially like a CD, similar to a bond, except that MYGAs do not pay interest regularly, but accumulate it in the MYGA account and pay out everything together at maturity. So let's begin with some sample rates for MYGAs, which have moved a little bit since the last time we shared this. Here you have the investment amount for each investment range, from $10,000 all the way up to just under $10 million. And here's a rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this AA+ carrier, your rate might be 4.2%. A $50,000 7-year MYGA might earn you 4.3%. A $100,000 7-year MYGA might earn you 4.45%. And a $1 million MYGA might earn you even 4.5% for 7 years. And if you have more than the amount shown here, say north of $10 million, your rate might go as high as 4.6% with this AA+ insurance carrier this coming week. So basically 5 basis points lower this week than the last time we shared this table with you the weekend before Christmas. In fact, the MYGA rates across the entire maturity spectrum shown on this table are 5 basis points lower than where they were 2 weekends ago. Because annuity rates track interest rates, though, this means that annuity rates, like interest rates, are still at above average levels when you compare them over the most recent 20-year period. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on a number of factors, including how strongly or not so strongly the insurance company you're buying your annuity from is rated. Meaning how risky or not risky your insurance company is. As a general rule of thumb, though, and all else being equal, the higher the rate, the lower the credit rating of the insurance company, similar to bonds. That said, your personal rate will also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's move on to Treasuries. There's usually a $1,000 minimum for Treasury transactions with most leading brokers, like Fidelity, Schwab, and Vanguard. Treasuries are more liquid than MYGAs because you can sell them before maturity on the secondary market at whatever the then prevailing market price may be. Remember that MYGAs usually only allow you to withdraw some part of your capital per year without penalty, for example, 10%. This liquidity advantage of Treasuries over MYGAs is also one of the main reasons why Treasury rates are normally lower than MYGA rates. As this table shows, the rates on Treasuries range from as low as 3.47% for a 2-year term up to 3.95% for a 7-year term. And what we continue to see here is that for a 2-year term and for amounts under $100,000, the rates for MYGAs and Treasuries continue to be fairly similar, between 3.4% and 3.5%. So as I've said before, if it were me, I would probably go with the 2-year T-note if this was my time horizon, given the small difference in yield and the generally higher liquidity of Treasuries. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over Treasuries, and more substantially so the further out you go and the more you invest. So, if you're comfortable with the illiquidity of MYGAs, their lack of regular interest payments, and the possible early withdrawal penalties before the term ends, or before you turn 59 and a half, and you want to lock in these MYGA rates for the long run, or if you're considering an annuity for the principal protection and guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. Annuities come in many different flavors. As I explained earlier, MYGAs, multi-year guaranteed annuities, work essentially like a CD, similar to a bond, except they do not pay interest regularly, but accumulate it in the MYGA account and pay out everything together at maturity. Whereas FIAs, fixed indexed annuities, allow for potentially higher market-based returns tied to the S&P 500, for example. FIAs come with full principal protection, but also with an upside cap, and might be something to consider if you want to stay in the stock market for the higher returns, but are concerned that we're headed towards a market correction, as we discussed in these 2 recent videos on how to protect your money against a bubble. Link below in the first pinned comment for your convenience. The first-year cap on a 7-year FIA for amounts $100,000 plus still stands at an attractive 9.25% at the time of this taping. For a 7-year cap that stays the same for the life of the FIA, that number also continues to be worth a look at 7.25%. There are also SPIAs, single premium immediate annuities, which can offer an immediate stream of lifetime income and fixed payments, and QLACs, qualified longevity annuity contracts, which are generally used to lower required minimum distributions, RMDs, defer taxes, and manage longevity risk if you have pre-tax retirement savings. You can check out these annuity videos here, all linked below this video if you want a deeper dive into who should buy a MYGA, some other type of annuity, or no annuity at all. Or shoot us an email at jennifer@NestEgg.com so that we can connect you with our trusted annuity specialists to see what your options may be, because there's no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations and fit properly in your overall portfolio, regardless of size. Moving on now to a usual table with Treasury yields from this past Friday versus the previous week across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black and decreases in rates are shown in red. We're seeing a bit of a mixed picture here at the shorter end of the maturity spectrum. Some green for the yields that were up for the week, some red for those that were down, and even a bit of yellow for the 6-month that was basically unchanged. That said, it was a short week with New Year's Day in between, so I'm not sure whether we can read too much into these end of 2025, beginning of 2026 movements. The picture for everything 2 years and up is much clearer. All green here, meaning higher yields. even if only by a single-digit basis point in some instances. You could say that this fits with a recently improving mood about our economy. For example, Torsten Slot, the widely followed Apollo chief economist, sent out this chart on January 1st under the title, U.S. Economy Enters 2026 in Great Shape. Never bet against America, as Warren Buffett used to say while running Berkshire Hathaway. And even though Buffett is now semi-retired as of January 1st, we here at Diamond NestEgg are still very much in the never bet against America camp for the long term, even if there may be some blips along the way in the short run. Now, let's take a look at Treasury yields from this past Friday versus 1 year ago on January 2nd, 2025. As before, this last row here shows the increase or decrease in rates since the beginning of 2025. And again, increases in rates are shown in black and decreases in rates are shown in red. The look back over 2025 shows essentially the same picture we've had for the past few weeks. Rates have been trending down. All yields 10 years and below are down by double-digit basis points, while the 20-year is almost flat and the 30-year is up a little bit, as I mentioned earlier. So, despite a persistent yield dip in the middle of the maturity spectrum, the yield curve overall has been steepening again in 2025, which is generally good news according to economic theory. A flattening curve is often seen as predicting a recession, while a steepening curve is seen as indicating continuing growth and maybe higher inflation as well. We'll see how this plays out over the course of 2026. But as a friendly reminder, once again, our current rates are still quite attractive if we compare them to the average yields over the past 20 years. You can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where Treasury and annuity rates ended the past week, let's move on to the next section for today. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bill auctions are happening as usual. Other than that, it's pretty quiet on the auction front, with no T-note, T-bond, or TIPS auctions scheduled, which is not unusual for the first full week of January. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 6-week at 3.605, the 13-week at 3.577, and the 26-week at 3.525. Please keep in mind that all of these rates can and usually do change all the way up to the time of the auction. Now, if you're interested in the higher annuity rates that we've shared with you in this table, drop us a note at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists, because annuities are not always straightforward. As I mentioned earlier, any annuity you purchase should be customized to your personal situation, regardless of the size of your portfolio. And again, if you want to learn more about safe ways to generate additional income in 2026 beyond what treasuries and annuities can pay, either via corporate bonds, high-yielding bond funds, covered call strategies, preferred shares, and other investment vehicles, do visit us at www.diamondnestegg.com and click on this yellow private VIP member community button to grab your $100 early bird discount and check out part 1 of our members only mini-series on corporate bond investing. Part 2 will be released shortly. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very, very soon with more brand new wealth building content for your financial journey.